Welcome back to the Deep Dive, where we tear through the sources so you don't have to. Today, we are pulling back the curtain on a corporation whose sheer size and foundational market dominance might genuinely surprise you. I mean, given how rarely they occupy the public consciousness or the major financial headlines, we are conducting a deep dive into American Tower Corporation, which is universally known by its acronym ATC. This company has executed a decades-long, very quiet strategy to become one of the world's most massive and successful real estate investment trusts. They operate the essential infrastructure. We're talking the literal steel and concrete right beneath the surface of the global communication systems we all rely on every single second of the day. Our mission today, built entirely from the sources you provided, is, well, it's threefold. First, we really need to understand the historical blueprint. How did this company manage to amass such a gargantuan, globally dispersed portfolio? Second, we need to explore their strategic pivot toward the future of connectivity, which involves, billions and billions of dollars moving into the data center space. And finally, what does their quiet dominance as the global landlord of connectivity mean for the future of technological competition and telecommunications reliability?
And setting the stage for that deep dive requires us to immediately define their core identity, because their structure really dictates their strategy. American Tower is an American real estate investment trust headquartered in Boston, Massachusetts, that owns, develops, and operates wireless and broadcast communications infrastructure across, well, numerous countries. What is truly fundamental to grasping ATC's business model is their classification as a real estate investment trust, or REIT. Now, for our listeners who may not be steeped in financial mechanics, a REIT is a company that owns and in most cases operates income-producing real estate. But crucially, REITs get special tax consideration. They generally don't pay corporate income tax, provided they meet certain requirements. And the most famous of those is that they had to distribute at least 90% of their taxable income to shareholders annually, in the form of dividends.
So if we translate that for the listener, they're essentially a massive global property management company, but for communications.
That's a perfect way to put it.
They hold the land and the steel, and the profit mechanism is the guaranteed, predictable rent they charge their tenants, the Verizons, the AT&Ts, the Vodafones of the world.
Precisely. They are separating the expensive long-term infrastructure ownership, the towers, the land, the concrete pads, from the highly competitive and, frankly, volatile service side of the business.
Right.
Service providers change, mergers happen, technology evolves, but the need for a physical location for an antenna, that remains constant. By structuring themselves as a REIT, they are treating these complex towers and now data centers as high-value, long-term rental properties, and that offers massive financial stability and attractive, consistent shareholder yield. This REIT structure is absolutely critical to understanding their ability to raise the just vast amounts of capital required for their acquisition sprees.
And to truly set the stage for the scale we're talking about, let's just anchor ourselves with their 2024 data. If you didn't know their name before this deep dive, these numbers will certainly stick with you. All right, so based on their 2024 reporting, ATC owns an inventory of 148,957 total communications sites worldwide.
Worldwide.
Just think about that for a moment. Nearly 150,000 separate physical locations, all dispersed globally. That is an enormous management challenge, and it just shows the scope of their physical footprint.
And their financial snapshot, it really confirms this scale. In 2024, they reported $10.1 billion in revenue. Their operating income was a hefty $4.52 billion, which, that just reflects the high margins that are inherent in the tower rental business. And their total assets on the balance sheet reached $61.1 billion. This is not just a successful company. It is an economic anchor in the global infrastructure landscape.
It is. And the speed at which they achieved this footprint is really the core of our initial analysis. We're talking about a company founded in 1995.
Right, just 3 decades.
Okay, let's unpack this. How did they manage to become a $61 billion asset holder and global infrastructure powerhouse in that short a time? They didn't start with a blank check. They started with just a brilliantly executed blueprint.
And that takes us right to their corporate origins and the foundational strategy that really defined their DNA.
That sets us up perfectly for segment 1, the blueprint and the legacy of AT&T Long Lines. As we mentioned, ATC was founded in 1995. It didn't just emerge fully formed. It was initially created as a unit within American Radio Systems.
Right.
And that's an important distinction. It was a subsidiary focused on broadcast towers, not yet the independent telecom giant we see today.
And the transition from an internal unit to a global player required a pretty critical corporate maneuver.
Yeah.
In 1998, American Radio Systems merged with CBS Corporation. It was in the aftermath of this massive media consolidation that American Tower was strategically spun off as its own independent, publicly traded entity.
And that separation allowed it to focus entirely on infrastructure ownership, right?
Yeah.
Unburdened by the content creation or media broadcast side of the business.
Exactly. A pure play on infrastructure.
And the initial strategy was established under their first CEO, a guy named Stephen B. Dodge, who led the company from 1998 to 2004. He oversaw the initial domestic growth and, interestingly, guided their first tentative steps into international markets almost immediately.
Oh, yeah.
They started operations in Mexico in 98 and then Brazil in 1999. They were testing the limits of their model right out of the gate, believing that this landlord model could be exported.
Dodge really established the template for capitalizing on infrastructure. But the true strategic masterstroke, the move that gave ATC an insurmountable low-cost foundation in the crucial U.S. market, that was their interaction with the relics of the old Bell system.
And here's where it gets really interesting, because this is the specific, surprising detail that truly defines ATC's foundation: the clever repurposing of forgotten, obsolete infrastructure. Around the year 2000, American Tower began this massive project, purchasing hundreds and then eventually thousands of AT&T Longline's microwave telephone relay towers.
And these were from the defunct AT&T Communications, Inc.
Right. This was the legendary, vast analog backbone of American long-distance communication.
And to really understand the significance here, we need to just pause and provide some context on the AT&T Longlines program.
Okay.
This was built primarily between the 1950s and the 1970s. It was the physical infrastructure that allowed phone calls to cross the country. It was designed to be robust, secure, and geographically strategic. They were often placed on high ground or mountaintops near population corridors.
So prime real estate for broadcasting signals.
The best. And they were even designed with Cold War-era robustness in mind. Many of these were bomb-resistant, concrete-reinforced structures built to last. But by the 1980s, these microwave dishes were being rapidly made obsolete by fiber optics, which just offered exponentially greater capacity.
So AT&T was just stuck with them.
Exactly. When AT&T decommissioned this vast analog network, they were left with thousands of perfectly sited, highly durable, but entirely useless concrete and steel structures scattered across the country. They were essentially abandoned real estate.
And ATC saw pure gold-plated real estate opportunity where AT&T saw scrap metal and tax write-offs. They were buying up the ghost network of the 20th century. The scale of this acquisition and conversion project cannot be overstated. These former AT&T Longlines tower structures across the U.S.
The number is staggering.
Totaling 42,965 structures. This single opportunistic move gave them instant prime positioning nationwide.
And this acquisition provided a massive competitive advantage. They didn't have to navigate local zoning or permitting issues for thousands of new sites.
That's a huge hurdle bypassed.
A huge one. They didn't have to buy the land, which was often already secured with long-term easements. They inherited a network whose geography was already optimized for long-distance communication.
Which translates incredibly well to wide area wireless coverage.
Perfectly. However, repurposing these was not a simple task. It required some serious specialized engineering work, which speaks volumes about ATC's early willingness to invest heavily to achieve that long-term gain.
Yeah, what did that involve?
Well, the towers were initially built to hold those massive, distinctive, often concrete, microwave horn antennas. Those horns needed to come off to make way for the modern, lightweight cellular antennas.
You mentioned this briefly in the sources, but I want to dive into the logistical reality for a moment. You're talking about removing massive horn antennas from remote, high-altitude locations. Was this really done using specialized equipment like helicopters? That sounds like an insanely expensive and difficult logistical process.
It was. And that difficulty just highlights the value they placed on the underlying real estate. In many cases where truck access was limited or dangerous, especially on remote mountains or high ridges, they did.
Wow.
They utilized specialized heavy-lift helicopters and massive cranes just to remove the analog equipment and install the new digital antenna mounting platforms. That tells us that the cost of removal and retrofitting, even with helicopters, was dwarfed by the long-term rental income potential of the tower structure and, critically, the quality of the site location itself.
The economic genius here is just profound. They were monetizing obsolete analog infrastructure, the physical residue of the Bell system for the nascent digital age.
That's it.
They weren't building from scratch. They were inheriting pre-zoned real estate for pennies on the dollar and retrofitting it for the digital future.
And that low-cost, high-leverage entry into the U.S. tower market was a critical foundational strategy. It gave them a massive portfolio advantage and allowed them to build capital for the next phase of growth.
Which was consolidation.
Consolidation. They had absorbed the physical residue of the previous communication era, and now they were ready to absorb the competition.
That momentum leads us directly into segment 2, consolidation and the first wave of global expansion. The company experienced a major leadership transition in 2004 when Stephen Dodge resigned. James D. Tigelaar was named CEO, and his tenure, lasting all the way until 2020, was when ATC truly accelerated its transformation into the global powerhouse we know today.
Definitely.
So what does this all mean? It means it got serious, systematic, and global about buying up the competition and establishing market dominance.
The Tigelaar era was really defined by scaling up and locking in that North American market share first. The sources point to major acquisition 1, the purchase of SpectraSite Communications in 2005, as the crucial consolidation move. SpectraSite was a significant domestic competitor, and absorbing them instantly altered the U.S. competitive landscape.
And what did that SpectraSite deal add to the portfolio? It was a major leap forward, wasn't it? Expanding their global portfolio to over 22,000 owned communication sites.
A huge leap. And this wasn't just towers. The sources specified included over 21,000 wireless towers, 400 broadcast towers, and 100 in-building distributed antenna system sites, DAS sites.
Okay, let's briefly explain the DAS sites because they represent an important nuance in connectivity.
Right, good call. So a distributed antenna system isn't a single macro tower. It's a network of small, strategically placed antennas designed to provide seamless wireless coverage inside large enclosed areas.
So think massive stadiums, airports.
Exactly. Convention centers, skyscrapers. Acquiring these 100 DAS sites showed ATC was already thinking beyond traditional outdoor towers and moving into high-density, specialized real estate for connectivity.
So the SpectraSite merger wasn't just about adding numbers. It was increasing the density and the complexity of their infrastructure offering in the U.S.
Absolutely.
And it established ATC as one of the, 2 or 3 largest tower owners and operators in North America. This concentration of assets must have given them tremendous leverage with the major carriers.
Tremendous leverage. The increased density and scale translated directly into better economies of scale and better bargaining power with carriers. This massive consolidation was the non-negotiable prerequisite for their subsequent, highly ambitious international expansion plans.
So build the stable U.S. base first.
Then look outward. Exactly.
Which brings us to the initial phase of that international ambition, kicking off aggressively between 2007 and 2012. They moved far beyond their initial toe dips in Mexico and Brazil. During this period, the expansion targeted major emerging markets. We saw operations established in India, Peru, Chile, Colombia, South Africa, Ghana, and Uganda.
That list of countries is incredibly telling.
It's a roster of nations experiencing massive population growth and rapidly increasing mobile internet adoption.
This was a clear strategic pivot based on foresight and market analysis. Mature markets like the U.S. already had high cell penetration.
Right.
Meaning the opportunity for new tower construction was finite and it was expensive.
But emerging markets?
Emerging markets, conversely, represented a blue ocean. They required massive, rapid build-outs to support billions of people transitioning from no connectivity to 3G and 4G connectivity almost overnight.
So ATC was betting that owning the steel in markets like India and South Africa would capture explosive long-term growth.
Precisely. They were strategically pre-positioning themselves for the next billion wireless users coming online, knowing that once a tower is built and a lease signed, that cash flow stream is extremely stable. Now, this strategy introduced higher regulatory and currency risks, naturally, but it promised superior growth rates compared to North America.
And this rapid international strategy was then significantly reinforced by major acquisition 2 in 2013, the acquisition of Global Tower Partners for $4.8 billion.
Another huge one.
That is a hefty sum, nearly $5 billion. This acquisition primarily strengthened their U.S. portfolio, further consolidating their domestic advantage. But it also strategically added operations in 2 new, smaller but crucial Latin American countries.
Costa Rica and Panama.
Right, Costa Rica and Panama.
And the consistent theme here, as you pointed out, is doubling down on successful strategies. They bought SpectraSite to achieve North American scale. Then they bought Global Tower Partners to deepen that North American position while simultaneously broadening their footprint in the highly lucrative and high-growth Latin American market.
So by this point, they weren't just reacting to market opportunities anymore.
No, they were actively shaping them by acquiring critical mass.
And we can see the unequivocal success of this aggressive global strategy when we look at their geographical snapshot as of 2024. The U.S. and Canada remain the stable foundational core with 42,222 sites. But the sources show where the majority of their growth capital went. Latin America is actually their largest single geographic segment outside the U.S. and Canada, commanding 48,307 sites.
More than in the U.S. and Canada combined.
Exactly. Following that, they have 26,642 sites in the Asia-Pacific Africa segments and 31,786 sites in Europe. Latin America is, by sheer site count, their most densely populated overall market.
And this geographical distribution, it just confirms the foresight of that early international drive between 2007 and 2012. They built the capital foundation on their repurposed American telecom legacy. But the engine of rapid site growth and future potential heavily relies on Latin America and Africa.
They understood that owning the ground and the steel is a stable, high-return business, regardless of the continent.
Right. They are diversified not just financially, but geographically.
A fascinating transition. But as we move into the 2020s, the game fundamentally changes. The infrastructure needed for 5G isn't just a bigger, taller tower.
Not at all.
It requires localized processing power. This brings us to the most recent chapter, involving dramatic investments and a pivot toward the core of modern data usage. This is segment 3, the data center pivot and the $20 billion acquisition spree between 2020 and 2021.
The new decade started with a key inflection point and a leadership transition. James Tacklet, who was the architect of their global scale-up, left in 2020 to take the helm at Lockheed Martin. This opened the door for Tom Bartlett, who served as president and CEO until early 2024, guiding the company through the immediate rollout phase of 5G. And this leadership shift coincided perfectly with the need for a massive strategic pivot away from just physical towers toward integrated digital infrastructure.
And that pivot was truly colossal, requiring immense capital. We are talking about major deals in rapid succession, signaling a fundamental shift in their connectivity strategy.
A huge shift.
They were transitioning from being just a tower company to becoming an integrated 5G digital infrastructure provider. They clearly recognized that to keep growing, they had to own the next bottleneck in the data chain. So let's start with Acquisition 3, which took place in early 2021, the purchase of the European and Latin American tower divisions of Telxius from its parent company, Telefónica.
This was a colossal deal, valued at $9.6 billion. That's nearly the cost of that entire Global Tower Partners acquisition from just 8 years prior. The scope was massive. Approximately 31,000 communication sites, instantly giving them deep penetration across Europe and further reinforcing their strong presence in Latin America.
Contextualizing the Telxius acquisition, it seems like it reveals two key objectives.
It does. First, it significantly expanded the European footprint, instantly giving them critical scale in mature, high GDP markets like Germany and Spain, where they needed to catch up with rivals. Second, it demonstrated continued commitment to their most successful high-growth region, adding to operations in Argentina, Brazil, Chile, and Peru.
So it showed ATC was still willing to spend massive amounts of money to acquire inventory globally, consolidating the tower market wherever possible.
Absolutely. But the truly eye-opening strategic move, the one that really defined their shift in identity, came later that same year, 2021, with Acquisition 4.
The purchase of CoreSite.
The purchase of CoreSite.
And the scale of this deal was even larger than Telxius, $10.4 billion. And the strategic importance was completely different. CoreSite provided carrier-neutral data center facilities exclusively in the highly competitive U.S. market. This wasn't steel and concrete in the middle of a field. This was high-tech, climate-controlled digital real estate.
And this is where we see ATC recognizing that the future of their business is entirely linked to ultra-low latency. We need to spend a moment on the technical imperative of 5G.
Okay, let's do that.
Traditional cellular infrastructure was fine with latency, the time delay for data to travel of 50 to 100 milliseconds. But 5G promises speeds necessary for mission-critical applications, remote surgery, autonomous vehicles coordinating in real time, or advanced industrial Internet of Things, IoT applications.
And these require ultra-low latency latencyy. We're talking sometimes down to a single millisecond.
A single millisecond. And you simply cannot achieve that level of near instantaneous response if the data has to travel hundreds of thousands of miles across the country to a centralized data center in, say, Virginia or Texas.
It's just too far.
Way too far. The solution is edge computing, where data processing moves physically closer to the user. CoreSite provided the perfect real estate for this. Critical, high-value, carrier-neutral data centers designed to host those localized servers. By acquiring CoreSite, ATC bought the physical hub where the data from their towers would now be quickly processed, often right at the edge of the network.
So the deal was explicitly cited as strengthening their position in the 5G rollout.
It was. It illustrates a masterful integration of tower infrastructure, think of them as the highway ramps, with edge computing capabilities, the rapid processing center just off the highway.
They bought the full, vertically integrated connectivity chain.
All while keeping the cash flow structure of a REIT. They had successfully pivoted from a simple tower company to a digital infrastructure titan.
It is just staggering when you put those two deals side by side. In 2021 alone, ATC spent exactly $20 billion, $9.6 billion for Telxius, and $10.4 billion for CoreSite on infrastructure acquisitions.
$20 billion in 1 year.
It demonstrates an incredible confidence and commitment to defining the infrastructure landscape for the next decade. But it also raises a question. How did they manage the debt associated with spending $20 billion in 1 year?
That's a crucial question. And the benefit of the REIT structure is its access to capital. But massive M&A always involves debt. The stability of their tower rental income provides the predictability needed to service large debts. They issue bonds against these long-term, non-cancelable leases.
So they're leveraging their predictable income.
Exactly. However, such massive spending implies that the growth opportunity and competitive advantage gained were considered well worth the increased leverage. They successfully leveraged their stable rental portfolio, built on those cheap AT&T long lines relics, to finance the complex, multi-billion-dollar future of 5G edge computing. It's a powerful testament to the financial model that's built.
That scale is staggering, but recent history shows that even the most massive corporations need to continually fine-tune and optimize their portfolios. They're now moving into an era defined by consolidation in some areas and strategic retreat in others.
That brings us to segment 4, strategic reassessment and divestments, covering 2023 and 2024.
This period is really defined by a simultaneous strategy of aggressive building and focused selling. The company experienced another leadership transition early in 2024. Tom Bartlett, who oversaw the CoreSite integration, retired on February 1st, 2024, and was succeeded by the current president and CEO, Steven Vondran.
And this new leadership is now tasked with refining and optimizing the enormous global portfolio they inherited.
That's right.
So let's look at the building side first, because they haven't stopped growing organically. In early 2023, the company announced robust plans to erect 4,000 new towers worldwide.
Right.
And the focus was very specific. High-growth regions like Africa, India, and Latin America. This shows they still believe in the core tower model, but only in geographies where wireless penetration is still ramping up and the demand for new structures is highest.
Right, they're not building in mature markets.
They are committed to capitalizing on population growth in developing economies. Absolutely. They are committed to maximizing asset density where demand justifies it. However, the headline-grabbing strategy has been the selling or divestment side.
Yeah.
And that signals a new era of optimization where returns trump raw site count. They've made 2 very significant strategic exits recently that highlight this focus. The first exit was in Mexico in 2023. ATC sold its fiber optics subsidiary known as APC Fibra Mexico to Flat Network.
So what did that signal?
It signaled a strategic decision to exit the capital-intensive fiber business in that region. Fiber is expensive to roll out, it's highly competitive, and it often has lower margins and less stable income streams compared to their core business of towers and data centers.
So they were essentially pruning a non-core asset that didn't fit the high-margin, stable REIT income profile as perfectly as their primary physical assets.
That's a great way to put it.
But the second divestment was far more significant given the company's history and scale. After 17 years in what had become one of its largest international markets, ATC divested its India operation in September 2024. They sold ATC India to Brookfield Asset Management via its Data Infrastructure Trust.
This is a monumental strategic reversal. They spent nearly 2 decades building a massive presence in India, one of the world's most populous and data-hungry markets.
Right.
The sale was valued at $2.5 billion, which, while substantial, marks a departure from a long-term strategic commitment.
So this raises the most important question for this segment. When does scale give way to strategic focus? Why exit a market where they had invested so much time and capital?
The sources suggest several potential factors, and they all really boil down to complexity and reduced returns. India is an enormously competitive market, and the regulatory environment can be highly volatile. Furthermore, the pricing pressure from local carriers there is intense. So while they had scale, the revenue per tower was likely significantly lower, and the operational risk significantly higher than in their core U.S. or high-density European and Latin American markets.
So the decision to divest $2.5 billion worth of assets indicates that the new leadership determined the capital tied up in India could generate higher, more stable returns elsewhere.
That's the logic. This could mean either paying down some of the substantial debt incurred from the 2021 spree, or, more likely, preparing for the next massive infrastructure purchase in a higher margin, less volatile market.
Like the data center space following like CoreSite template.
Exactly. It's a sign of a very disciplined, capital-conscious approach to portfolio management that values quality of income over sheer volume of sites.
So they're actively managing their portfolio, selling what they see as complex, lower return assets like the India towers, the Mexican fiber, to potentially fund even more lucrative, future-facing assets like edge data centers.
That seems to be the play.
Despite these shifts in divestments, ATC remains an absolute powerhouse, reinforcing their industry standing. The latest metrics confirm their position. They topped the list of the top 100 tower companies in the U.S. in 2025. And reflecting their comprehensive financial scale and stability, they are ranked 363rd on the Fortune 500 list.
They have firmly established themselves as one of the essential, powerful cogs in the global digital machine.
Operating out of sight, but fundamentally necessary for every byte of data transferred.
The transition they've made from an opportunistic startup, literally retrofitting Cold War-era architecture, to a fundamental infrastructure provider for 5G data processing is, well, it's remarkable. These rankings reflect the stable, essential, and geographically diversified role they play in the global economy. They are the definition of essential infrastructure in the digital age.
And that brings us to our final synthesis, tying together the history, the strategy, and the massive capital moves. We have charted ATC's journey from its foundation in 1995 as a unit of American radio systems, achieving initial scale by capitalizing on decommissioned telecom relics, those forgotten AT&T long-lines microwave towers, to its current state as a multi-billion-dollar asset manager leveraging the stringent demands of 5G through data centers and aggressive global consolidation.
The core identity remains fundamentally the same, but the scope has exploded dramatically. ATC is not merely a utility or a service provider, it is the global landlord of connectivity, renting out the physical space required for modern communication. Their success demonstrates a powerful, simple truth. In the rapidly evolving digital age, physical real estate, be it a massive steel tower planted on a strategic mountain peak or a climate-controlled data center near a fiber backbone, remains the ultimate indispensable foundation for all wireless and high-speed data communication.
So as the listener, what are your critical takeaways from this deep dive that will fundamentally change how you view the telecom landscape? First, understanding the REIT structure is foundational to understanding their financial stability. They are landlords of physical assets that generate predictable, long-term, high-margin rental income.
Right.
And that separates them from the volatility of the cell service providers. This stability is what allows them to raise billions of dollars for acquisitions. Second, never overlook the historical importance of the Bell System microwave legacy. ATC's massive initial scale and low-cost entry into the U.S. market were based on literally repurposing the ruins of one telecom giant to build its own foundational empire. That initial opportunistic genius fueled decades of subsequent acquisitions.
It was the bedrock of everything that came after.
And finally, pay attention to the scale and focus of their recent investment strategy, that massive targeted $20+ billion spree in 2021. The Telxius acquisition provided global scale, but the CoreSite acquisition for $10.4 billion defined their future.
It did.
It was a pivot toward critical 5G edge computing. That move is the clearest signal of their trajectory toward becoming essential processing infrastructure, not just passive infrastructure.
And building on that analysis of their current trajectory and their focus on disciplined capital, let's leave you with a final provocative thought to consider.
Okay.
Given ATC's recent divestment from its fiber business in Mexico, and, even more critically, its exit from its largest international market, India. Should we view these moves primarily as a consolidation of capital specifically for the next massive infrastructure purchase in the high-value 5G data center space, following up on the success of CoreSite? Or should we interpret this as a signal that they have concluded that traditional tower infrastructure in complex markets has reached a point of diminishing returns, and they are optimizing their global portfolio exclusively for higher regional profit margins, regardless of growth potential? You have the facts about their history and their financial moves. Now you can analyze the trend for yourself.
A truly critical question regarding the future of global connectivity ownership. Thank you for joining us for this deep dive into American Tower Corporation. We will catch you next time.